This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! Help attract more borrowers and build a more resistant loan portfolio. Payment Guard Insurance from TrueStage is a first-of-its-kind insurance solution designed for digital lenders to do just that. Visit www.truestage.com/payment-guard to learn more and talk with a member of the TrueStage team. Hello, and welcome back to everybody's favorite bank nerd podcast, Bank Nerd Corner. This might be the only bank nerd podcast, or at least like the one that's so flagrantly goes out of its way to describe how proud we are of being nerds. I'm Alex Johnson. I am joined, as always, by my co-host, Bank Director's own Kiah Haslett. Kiah, thank you for joining me, as always.
Thanks so much, Alex. I'm going to formally challenge any other podcast that represents they are bank nerds to a bank nerd competition. There can only actually be one bank nerd, and I'm willing to fight them for it.
I like it. It's kind of a Highlanders sort of rule. That makes sense to me. I'll just be like the judge. I don't want to fight anyone, but Kiah will fight you. So if you want to step up to the plate, feel free, although I would not recommend it. We are also absolutely delighted, as is becoming a bit of a tradition here on Bank Nerd Corner, to be joined by a special guest. Kiah, would you mind doing the honors of introducing her?
Sure. Joining us today is Julie Hill, the Vice Dean and Alton C and Cecile Cunningham Craig Professor of Law at the University of Alabama. Hi, Julie. Thanks so much for joining us.
Thanks for having me.
Yeah, you would be like a first ballot, obvious inductee into the Bank Nerd Hall of Fame. In fact, when Kiah and I were starting to map out who we might want to have on as guests of the podcast, your name was literally at the top of the list. So we are delighted to have you join us and to answer some questions that I think Kiah and I have been bantering back and forth about a little bit on the podcast, a little bit just via text, but we are not experts. You are an expert, so we are delighted to have you.
Well, great. Glad to be here.
No pressure. You're going to be great.
Yes. We're very much looking forward to it. So where we're going to spend a majority of our time today is on the subject of Fed master accounts. Julie, this is something that you've done a tremendous amount of work on. You've provided great analysis and information. I've certainly learned a lot. And so we're hoping to share some of that knowledge with listeners as well, because this has become a bit of a hot topic. So I'm going to start off playing my role as the dumb person on this podcast. Let me start by asking a dumb question. What is a Fed master account? Who has one and how do you get one?
So I think the easiest way to think about Federal Reserve master accounts is it's more or less a bank account for a bank.
Okay.
So the Federal Reserve is, of course, best known for its role in monetary policy. But in addition to that, it provides payment services and is also a receptacle for bank reserves. And so the regional reserve banks have accounts and provide payment services to more or less financial institutions. So there are some entities that are not banks that have a Federal Reserve master account, but by and large, Federal Reserve master accounts are just a bank account for a bank.
Well, that is a wonderfully concise overview, but yeah, Kiah, dive in because I think we have more questions.
But of course, it gets more complicated.
Yeah, exactly.
That's about as straightforward as we can make this because it's only going to get harder. Yeah, so for a bank reporter, it seems like, kind of, if you have a bank charter, you have a master account, no more questions. And obviously you don't have to. There's like the Fed member bank thing that banks can opt into. But we're here talking about this not because of banks getting accounts, but non-banks getting accounts or non-banks not getting accounts. And this kind of popped up surprisingly around 2015 when we started seeing states legalizing marijuana or cannabis use and then trying to figure out how financial institutions could provide financial services to these companies. And, outside of all the challenges of even just getting a bank charter or a financial services charter for those services or for those entities, the next hurdle they had to overcome was getting access to these accounts. So in 2015, Four Corners Credit Union in Colorado is trying to form and they're trying to get an account. And the Fed, I think it's the Kansas City Fed that they would have had to apply with, was kind of slow rolling that account. And then we kind of learned from there a number of other surprising things, including that same Reserve Bank had granted a non-bank financial technology company an account. And then, we have, with the rise of the crypto financial services companies, some of them trying to get access to accounts. So, that's kind of some of the developments we've seen around this account application process, or the request process, I think is what it's called. So can you fill in some history here about, kind of how does a company get an account? And then why, can you help distill this controversy around who gets an account and why should we care about who gets an account?
Yeah, so maybe just to solidify our position as nerds, we will go back to sort of the very beginning of the Federal Reserve.
Yes.
So one of the things that Congress was looking for when it created the Federal Reserve System was a way to make the payment systems function better in the United States. And so back then, one of the primary methods of payment was by check. And of course,
I've heard of that.
There wasn't electronic clearing or electronic transfers like there is now. And so if you wanted to clear a check that was drawn on some other bank, you'd send it to a correspondent who eventually would get to a bank that they shared accounts. And this could take a very long time. And it meant that checks had to essentially trade at a discount because it was so hard to collect them. So one of the things that the Federal Reserve was looking to do was to figure out a better way for handling payments because they thought this would help commerce. And so to do that, they needed to get banks to join the Federal Reserve. And they did that by buying stock in the Federal Reserve banks. And one of the requirements is that they had to keep reserves at the Federal Reserve. But this is going to be kind of problematic because if a bank has a choice between buying into the Federal Reserve and keeping high reserves, or just having a state charter and not being a member bank and having lower reserves, nobody's going to pick the Federal Reserve. So they had to come up with some sort of incentive to make people want to join the Federal Reserve to be members. I'm not people banks, right?
Yeah.
But there had to be a reason for this. And so what they started to do is they started to provide payment services, wire transfers. FedWire was one of their very first services, but also to facilitate clearing. And they did this at cost for their members. So one of the benefits of joining the Federal Reserve System was that you got access to the Fed's payment systems at a low cost. And so we went along like that basically until the late 70s. And so what started to happen in the late 70s were a bunch of different things. One of them was the development of the ACH system, the automatic clearinghouse that processes batched electronic transactions, your automatic payroll system deposit, or your gym membership every month. And the ACH systems were created by clearinghouses created by banks, but nearly all of those clearinghouses chose to have the Federal Reserve be the provider of these services. And of course, the clearinghouses that were created by banks were keen to only provide services for banks. They weren't keen to provide services.
Like a club, like a members only club.
They didn't want to let credit unions in the club.
Yeah.
And so the credit unions were suing to try to get access to the clearinghouse, and there are some antitrust cases. So while that's going on, the Federal Reserve is facing another problem. The membership in the Federal Reserve had dwindled, in part because, they had to keep higher reserves, and there were other ways to get access to payment clearing. And because the Federal Reserve membership was dwindling, the Federal Reserve's ability to influence monetary policy by changing the interest rates, they were worried that that was going to be impacted. If the rate that you lend to these banks that are members is only impacting a small number of banks, you have less leverage on your monetary policy. So they were facing kind of a membership crisis. And so at the same time, there's this pressure to let others, non-banks, credit unions, have access to the payment processing services. You've also got this pressure to increase deposits at the Federal Reserve. And so one of the things they could have done is just said all banks have to be members, but that wasn't very politically palatable. And so the compromise that Congress hit on in the Monetary Control Act of 1980 was that all banks were going to be subject to reserves. But now going forward, even non-member depository institutions were going to have access to Federal Reserve accounts and payment services at cost.
So the Congress got to tell the Fed, we'll talk about this later, but Congress got to tell the Fed in this instance who got to join the Federal Reserve as a member and access those benefits.
Yeah, so before 1980, it was basically members. And there were some trust companies that aren't regular banks, but it was members. After 1980, it was kind of the same list of institutions, but instead of just being member banks, it could be any depository institution or trust account. And so this meant that now credit unions, even credit unions that didn't have federal share insurance or federal deposit insurance, could get master accounts at the Federal Reserve. And I think from 1980 clear up through the state legalization of cannabis, nobody really gave it much thought.
Sure.
If you had a bank charter of some type, if you were a depository, whether you were a credit union, whether you had private share insurance, if you asked for a Federal Reserve account, it took them a couple of days and you had one open, right? Like it was not a gatekeeping process. If you'd managed to get through the chartering process at either the federal or the state level, you were going to get a Federal Reserve account.
So why does cannabis kind of cause the Federal Reserve system to reconsider who gets access?
So marijuana is still illegal under federal law. And so even when states decide that they're not going to enforce that federal law anymore, and it's not going to be illegal under state law, it's still money laundering to deal with money that touches cannabis. So there are lots of different ways to commit the federal offense of money laundering, but basically anytime you give money to or from an illegal enterprise, you've got money laundering. And so this is a problem for the state legal cannabis industry because any handling of marijuana-related funds or cannabis-related funds were technically money laundering. And so this meant that lots and lots of banks and credit unions didn't want to do business with the cannabis industry, especially because they were worried that their federal regulators, who were still tasked with enforcing federal law, like the OCC, or the FDIC or the Federal Reserve, might decide to punish them for this. And the federal regulators did a little bit to help on this. They issued some guidance about reporting to the Financial Crimes Enforcement Network when you had a state compliant, but still not very many banks wanted to do it. So Colorado got thinking about this problem because they didn't like the idea of just piles of cash sitting around at these cannabis companies. And so they said, well, look, we have a dual banking system. And technically, under Colorado law, you don't have to have federal insurance to be a credit union. You can have something that's equivalent. And so let's just charter a credit union to serve the cannabis industry. And of course, there were some organizers who thought this was the best idea ever. And so they applied and received a charter for Fourth Quarter Credit Union and applied for a Federal Reserve master account at the Federal Reserve Bank of Kansas City. They also applied for share insurance from the NCUA. And the Federal Reserve Bank of Kansas City looked at the application and you can understand why they might have consternation about it because the whole business plan of Fourth Quarter Credit Union was we're going to serve an industry that's illegal under federal law. And so I imagine, I don't know, I didn't sit there in the Kansas City Fed, but I can imagine those folks sitting around there scratching their head and thinking, we've just been asked to become money launderers. Should we do it?
Should we allow money laundering? Yes or no?
And So there was some litigation about this. It goes up on appeal to the 10th Circuit. You get a decision made by a 3-judge panel, and none of the 3 judges can really agree. And while all this is going on, Fourth Corner eventually says, well, we're only going to serve the marijuana industry if it's okay to do it under federal law. And so we have this sort of modeled case law out there that doesn't resolve the question of what sort of discretion the Federal Reserve has to grant these. But I guess from my perspective, the real difficulty with the Fourth Corner application was this nexus with money laundering, because surely it can't be that a federally related entity can be forced to violate federal law. I mean, that seems difficult. But what Fourth Corner did was, I think, start the Federal Reserve to thinking about whether there ought to be some guardrails around who gets access to Federal Reserve master accounts. And they start thinking not just in terms of banks or financial institutions that might be engaged in illegal activity, but they start to think about banks or other institutions that might be engaged in what they think are risky activities. And so then we see some follow-up on that.
Well, I was going to ask about that. So first of all, that was an amazing history of the whole issue. So thank you. That I might only appeal to me and Kiah, but that was amazing. So the second thing, though, that I want to ask is building on what you just said. Fast forward from 2015, I mean, you laid it out really good. Right up until that moment where they were asked to essentially participate in money laundering, the Federal Reserve, it sounds like, since the Monetary Control Act, didn't really treat this as an issue. It just had never really presented itself as a question of whether you were going to grant one of these. You just did. And once that sort of changed in 2015, then all of a sudden there's this sort of larger open question, which is, well, what exactly might else we consider to be unacceptable to essentially be connected to the Fed's payment systems? And the thing I'm really curious about is that question, which starts lingering after Fourth Corner, that also runs smack into something that I think Kiah and I are both very curious about, which is the explosion in fintech and just this like pressure that is oftentimes supported at a state level for new types of banking charters, new types of banking activities. And it's not just cannabis, which is a clear-cut case of, hey, this is money laundering because it's illegal at a federal level. It's crypto, as Kiah referenced. It's all kinds of different activities and different types of charters. And again, our dual banking system is delightful this way. At a state level, you have some states that are very aggressively courting different subsectors within financial services. Some want to be the home of crypto banking. Some want to be the home of cannabis banking. Some want to sort of encourage more financial services innovation. Some states do not. But at a state level, there are more of these different novel types of charters being created, granted, or used in novel or new ways. And I would imagine that that puts a lot more pressure on this question. So can you sort of catch us up on the modern history of this being sort of litigated between the Fed and all of these private parties?
So I think another thing that we've seen recently is, particularly since the 2008 financial crisis, we've seen the traditional chartering agencies be skeptical of new, innovative business plans.
Yeah.
And so the FDIC really didn't want to give deposit insurance to new financial institutions because they wanted people to buy up those failed financial institutions from the 2008 financial crisis.
Right.
And the OCC got really hesitant to issue new bank charters. And so we start to see people noticing places where there's less than perfect financial services. So some of that relates to payments and wanting payments to be more modern and faster and more accessible to a wider range of people. And some of it's just wanting access to financial transactions and financial services. So one of my favorite examples of Fed master accounts isn't a fintech at all. It's the Territorial Bank of American Samoa.
Oh yeah,
wow.
I loved reading that in your paper, and the kind of the need to provide the financial services to a really isolated territory and their difficulty in standing up a chart and getting a charter because of the account, right?
Yeah, so American Samoa is a long way from the continental United States. I mean, it's really even a long way from Hawaii, and they had been served for a long time by essentially two financial institutions. One was the Bank of Hawaii, just a traditional commercial bank, and the other was the Australian bank ANZ or ANZ, depending on, I guess, where you live. So, but the Bank of Hawaii decided they were leaving American Samoa. And so American Samoa the government tried really hard to get some organizers to start a credit union, to get some organizers to start a bank. And they couldn't ever get any traction to get a private institution open. And so the legislature there in American Samoa decided to create a state-owned bank, the Territorial Bank of American Samoa. And there was some precedent for this, like way back at the time the Federal Reserve was being created. North Dakota had done something similar. And of course, the Bank of North Dakota is still operating. But part of the reason it's still operating is because it got in so long ago.
Right.
Nobody's decided that they wanted to kill it in the interim. And so American Samoa, they're first to act as a correspondent. We don't need a Federal Reserve account. They're going to use Zions Bank in Salt Lake, Utah, to be their correspondent right up until Zion's regulator told them that that was a very bad idea. And so this made the Territorial Bank of American Samoa seek a Federal Reserve master account. But the Federal Reserve was skeptical because it didn't have any insurance, not any insurance at all, not private insurance, not federal insurance. And the FDIC had pretty publicly stated that they were uninclined to grant federal insurance to a state-owned institution because they were worried about corruption that had plagued some state-owned banks in the early 1900s, late 1800s. And so, they're trying to convince the Federal Reserve. They do eventually get a master account, I think. If, again, I'm sort of...
You can go check the database.
Yeah, they did get one.
Okay.
But I think the reason that they did was simply because folks at the Federal Reserve finally realized that there was going to be no banking service. There was going to be no way for people to make payments to or from the rest of the United States. They were going to be completely economically isolated. And that is just not a very politically palatable result to just say, American Samoans, you're out of luck. You cannot have banking.
Right.
And you can see why they might have been nervous, or maybe you're still nervous. Right? The regulator is like one person there in American Samoa, and, it's far away. The Federal Reserve isn't going out to visit them all of the time. But that shows that they're starting to think about the risk presented by these. And you've got other folks who would like to start state-owned banks. California would like to have one to handle cannabis money.
Sure.
Other places, San Francisco wants to have a city-chartered bank to help poor people have access to credit. And then you've got the
Fed.
Fintech. And they look around and they say, well, look, we don't necessarily need a whole bank. Maybe we only want to do part of banking. Maybe we only want to do payments, but we don't want to make loans. Or maybe we only want to, do we really need like this big fancy all parts charter? Or maybe we could do with something smaller and, with less powers. And maybe that should be easier to get and more economical. And why can't we do this? Part of what's driving them too, though, are that the Fed provides these payment rails.
Yeah.
And the way to get to the payment rails now is to ask a bank.
Right.
But if you're a fintech, you're basically asking your competitor to provide you access to the market.
Right.
And so fintechs are very worried that if they're going to partner with banks, the banks are just going to raise the prices on them until they're priced out, and or that they're going to steal their technology. So they'll work with them until they figure out how it works, and then they'll kick them to the curb, and then the bank will do it themselves. So the fintech takes all the risk and the bank has all of the upside. So they're saying that, look, banks are hoarding this access to the payment rails. And wouldn't it be better if there were other charter types and other ways to get access to the Federal Reserve that didn't require them going through their competitors to get access?
Well, and Julie, that's kind of interesting. This is something that like Alex and I have talked about, is that the perception that the payment rails are kind of a public utility that people could have, and there's a right to access. But the whole nature of the Federal Reserve and the reserve banks is that this is a quasi-public private institution. And so that sometimes some of their information, some of their activities are public and some of them are really private and you can't get access to it. And, with the master account specifically, Custodia has done a lot of work on the legal front to, if not get themselves a master account, to at least bring transparency into both who has one of these things, right? Like this, the idea that this is even the list of who has a master account public information. Is that something that the Federal Reserve needs to act as proprietary? Who's in the members club, if you will? And then also even writing down how would you even assess an application, right? That it can't be just based on like vibes, right? Like it can't be like, well, we are scared, so we are going to say no, right? There should probably be something a little bit more formal. Can you talk a little bit about either of those two things, kind of the database and or what we all have to now pretend is clear guidance about who gets a master account and under what, the timing?
Yeah. So when I first started writing about master accounts, one of the first things I wanted to write about was the process for getting them, because the Federal Reserve was so secretive about it that nobody knew, how do you even apply? There was this one-page form that sort of seemed like it was an application, but you just filled out like the name of the bank, the person that you were supposed to contact in an emergency. There was a place for your ABA routing number and like what date you'd like the account to be opened. It wasn't like provide us your business plan or give us audited financials or tell us who's in charge of running this thing. And so it was clear that there was, or at least starting to be, some amount of vetting, but it wasn't clear, even when I first started, who was doing it, whether it was being done at the Reserve Bank level or whether the Federal Reserve Board was involved in it. It wasn't clear if the reserve banks ever talked to each other so that they're making consistent decisions. And so I think that this was sort of problematic, in part because some of these requests would just languish for years.
What I like to imagine when I was reading your paper about the application is that every single day a Federal Reserve employee walks into his office and he looks at that paper and he's like, can't do it today.
Not today.
And because these requests take years, Alex, and like it's not clear. Like I assume there's some back and forth on the document submission or whatever, but
it used to take days, right? Like when this wasn't a controversy, it was like a couple days, boom, here's your account. You open an account at the Fed.
Yeah, so I think then what happened as it became a bigger and bigger issue is the Federal Reserve decided, or at least parts of the Federal Reserve, maybe individual reserve banks and a person here and a person there, decided that there ought to be a more regularized process for this. And I think that the first Federal Reserve Bank to kind of speak up about this and do something about this was actually the New York Fed. And the reason that they were quite interested in this issue was because Puerto Rico has two charters, one for international financial enterprises and international financial banks, but they're essentially the US version of offshore banks. So they can provide services to people that live outside of Puerto Rico, but not people inside of Puerto Rico. And they don't have federal insurance or anything because we don't care about the foreigners. So, but there was concern that there might be some money laundering at some of these IBEs and IFEs. And then there was concern about just whether they were risky in general. And so the New York Fed came up with some things that they were going to consider for these what they thought were non-standard account holders. And so they were going to look into this. And then we start to see people like, or institutions like Custodia and the Narrow Bank up in Connecticut, institutions that don't have standard business plans and don't have what you think of as a traditional bank charter requesting access to the Fed. And so while all these applications are out there pending, the Federal Reserve decides, I guess, to get together and issue some guidelines about how they're going to review master accounts going forward. And they divide applicants into 3 categories. Tier 1 being what we think of as standard banks or credit unions that have deposit insurance. Tier 2 being ones that have some amount of federal oversight. And Tier 3 being, I guess, what they think of as the state chartered rogues that don't have someone already acting as a regulator from the Federal Reserve. And so that's where we're at now. But, you mentioned Custodia, and Custodia is an interesting story too. Custodia is a Wyoming special purpose depository institution. Wyoming, which I assume moving there. So I have lots of great things to say about
we're moving back. On the ground correspondent.
We're moving back there.
But, we'll have to have you back as our crypto correspondent in the future.
Well, so the Wyoming legislature has a history of innovation in what I would think of as banking and business. So they were the first legislature, for example, to pass legislation creating limited liability companies. They're created by the Wyoming legislature. But they decided that one of the things they wanted to do to try to attract crypto and banking companies to Wyoming was to have this new charter for special purpose depository institutions. They can't take what we think of as retail deposits, and they can't really make loans either, but they can act as payment processors. And so, but you don't have the credit risk because they're not doing lending. And so they say, well, that ought to be easier to approve because you just make sure that they have adequate reserves, and you make sure that they aren't lending, and you make sure that they're good at payment processing, and then you can have one. So Custodia said, well, that's what we want to do. We want to custody crypto assets for corporate clients, and we'll do a really good job of that. And we want access to the payment rail so that we can send wires and stuff like that. And Wyoming thinks it's a great idea. They give Custodia a charter, and then Custodia begins its odyssey of trying to get a Federal Reserve master account. And they're still fighting. We'll see.
Well, something I wanted to ask about is, so you've mentioned fintechs, and you mentioned that right now a lot of fintechs have to use bank partners to gain access to payment rails. The Federal Reserve recently announced the Novel Activities Supervision Team. And, I'm kind of thinking about that role of the Federal Reserve as a regulator and the Federal Reserve as a payment facilitator. And I was wondering, do you see, thinking about the Fed being concerned about novel and risky activities moving over the payments, and that some of these Puerto Rican banks might lose their charter, as you've written about, do you think there might be any concern from banks that their examiner might think like, well, your activities are too risky. You have a Fed account now, a master account now, but if you don't reduce the risk of this, you might lose the access to the account. You don't lose your bank charter over it. We're not going to revoke the charter, but we wouldn't just want you to have access to move the money around. Is that I don't know how big of a concern that is, but I certainly see this as something that is within the Fed's power because it's their account and they're already trying to pull the master accounts from these Puerto Rican banks.
Yeah. So the thing to remember about the Fed is they don't have any chartering authority. Right. Nobody goes to the Fed when they want to be a bank. They go to Puerto Rico or Wyoming or the OCC, and that's how you get a bank. The Fed doesn't create any banks. Now, banks could ask to be Fed members, but still the Fed doesn't make them banks. It's some other entity that's decided that these entities can be banks. And so there have been instances in Puerto Rico where the Fed has been concerned, they say, about money laundering, and they have closed Federal Reserve master accounts over that issue. But they say that they're not acting as regulator because they have no regulatory authority over their banks, because they're not member banks and they don't have a charter from the Fed. So literally the Fed's only tool there is the master account. I think if you had a more traditional bank that was a member, I think that they would exercise their authority through the regulatory process long before they got to closing the master account. But I think what you're seeing here is that the Fed is using the only tool that it thinks it has to impact these Puerto Rican banks. I can't tell Puerto Rico not to give them charters because they're not in charge of Puerto Rico.
Yeah.
And these people aren't asking for anything else from the federal government. They're not asking for deposit insurance. They're not asking for Fed membership. So they're using the only tool that they have.
That brings up another dumb question I had, which is I was just trying to think about it from the Fed's perspective. And, the cannabis example was the one that really hit home for me because, do we really want to enable something that we know is money laundering from day one? Yeah, we don't feel good about that. That makes sense to me. But it is interesting when, as you just illustrated, these things cross over between different boundaries within the broad umbrella of what the Federal Reserve is responsible for, right? Because when I think about the granting of master accounts, I'm thinking narrowly about, okay, this is the group that operates the payment infrastructure that a large portion of the U.S. financial services ecosystem relies on. And I was sort of wondering in my head, so what's the bad thing that happens to that infrastructure if the Federal Reserve grants these master accounts to institutions that turn out to be overly risky? Does something break? Is there some thing that happens to the payments infrastructure? Yeah, so it's there's a money laundering. Are they going to not
enact monetary policy to Powell's specifications?
Yeah, so I was just trying to, maybe you can kind of illustrate this for us or illuminate this a bit, but from the Federal Reserve's perspective, what's the bad thing that happens if these overly risky institutions that we've deemed these tier 3 institutions that we're not comfortable with get access to this and they turn out to be risky? What breaks?
So according to the Fed, the whole world will implode. So, really, it'd probably be more fair if you ask someone from the Fed, but I will try to offer their perspective with minimal snark. And then we'll get to the snarking. So they have several concerns. One of their concerns is about monetary policy. So one of the banks, TNB, the narrow bank up in Connecticut that wanted Federal Reserve master account, their business plan is they just wanted to get large corporate accounts and take the money and park it at the Federal Reserve. And they say, well, look, if you're a really big company and you keep your money at Wells Fargo, you're not really going to be protected at all by the deposit insurance limit because it's so low. And so if Wells Fargo goes out of business, you're going to lose your entire deposit. And so they think that there is some market for a financial institution that just keeps money at the Federal Reserve, that doesn't lend it out, that's super safe, right?
I was going to say, post-SVB, that became a thing or a talking point. I'm not necessarily in favor of it, but keep going, Julie.
So the Federal Reserve says this would be horrible because if ever there was financial difficulty, what would happen is that all of the big deposits would leave Wells Fargo and Bank of America and Citi and flow to these narrow banks. And we'd have bank runs and panics and horribleness. And because they're not lending it out, the economy would grind to a halt. And they won't be able to control as well the size of reserves. And so they won't have, in addition to exacerbating runs and panics, they're going to impact the Federal Reserve's ability to engage in monetary policy. And this is all going to be really horrible. They also have a parade of horribles about business models that are more like just payment processing, because they say, look, if at the end of the day, these counterparties are so risky that they can't settle, that's going to send a ripple effect throughout the whole financial institution. And that would be really, really bad. And then finally, they say, well, if there's no money laundering watch at all, if we're just money laundering, that would also be really bad, because what we're going to end up doing is financing terrorism throughout the world. And, now is not just a financial problem, we're going to have genocide. So unless we have control over these master accounts, we're going to have genocide.
What is your take on that?
Well, they let everybody have access from 1980 until fourth quarter, and we managed not to, implode the whole world. They still have to get a charter from somewhere.
Yeah, they're still regulated, right? Like even Custodia would have a regulator, right?
Custodia has a regulator. And again, I'm about to move there and work for the state of Wyoming.
The great state of Wyoming, yes.
The great state of Wyoming. So it irks me a little bit that the Fed seems to be saying, these yokels who work for the state of Wyoming are not quite as smart as the rest of us.
We know better.
You can see how I might be slightly sensitive about that.
TrueStage Payment Guard Insurance is a first-of-its-kind insurance solution built for digital lenders, designed to help you attract more borrowers, strengthen your loan portfolio, and reduce time spent on collections, all with minimal tech lift needed to go live. To learn more about Payment Guard Insurance, visit www.truestage.com/payment-guard and speak with a member of the TrueStage team.
I came across an American Banker article that said the state of Texas has a master account at the Fed, and my own local Tennessee Valley Authority, which is a utility in Tennessee, has an account at the Fed. And it seems like, while it's probably a pain in the butt for the controller or the comptroller of each of these groups to maintain the Fed account, the reserves, I think they did it because it's just a little bit easier to manage payments. It saves them some, payment processing fees. And so these are some of those legacy institutions, these non-banks that very clearly just saw use in the payment rails in, our states,
Yeah, so there's a separate statute that allows basically government-sponsored enterprises like the TVA and Fannie and Freddie and some financial market utilities, the clearinghouse, people like that to have. So I kind of want to leave those to one side.
Okay, so you said this is different than the non-bank.
Well, so Congress said they could have them, right?
Okay,
and
fair.
so since Congress created these things, we can argue about whether it's a smart idea or not, but Congress at least created them. All these others, it sort of seems to me like Congress said everyone gets access, and the Fed says, no, that was a bad idea. And I guess the lawyer part of me says that's not how it works. When Congress says everyone gets access, what that means is everyone gets access. But of course, the Federal Reserve and I disagree about that.
It is interesting, too, to think. So the point that, all of these charter holders have a regulator, if the Fed is worried about money laundering over its rails, wouldn't that be some pretty important information to tell the regulator? So the regulator can tell the charter holder that they are in violation of money laundering rules versus the Fed is almost like it's a facilitator, but it's also kind of being an enforcer here, right? Why should they be worried about money laundering? Wouldn't you just tell the regulator that you're worried about money laundering? I don't know if that makes sense.
You're talking crazy, Kiah.
So you can just do your job. You don't have to do someone else's job.
So I think that the Federal Reserve as a payment operator is not particularly well suited to suss out money laundering, nor do they really want to do that. And I think that here they're just concerned that, and so maybe let's talk about Puerto Rico since I can perhaps be a bit more objective there. But their concern is, look, these IBEs and IFEs are big business for Puerto Rico. The Puerto Rican government wants to keep them open. And so maybe the regulator isn't as concerned as we are about stamping out money laundering. I guess we could say the same thing about Wyoming. Look, Wyoming, really wants to have crypto. And so, if they were more clear-eyed instead of what's in it for them, they would realize that these were really bad charters and we just don't trust them.
The state of Delaware is just handing out the incorporations, the articles of incorporation. It's one of the largest shell companies in the world, and we're focusing, it is interesting kind of where are we assigning risk, what's a hot zone that needs to be dealt with and what's something that's just totally normal and has been going on for decades, nothing to see here.
Yeah, well, I mean, corporate charters everywhere have more or less been a matter of pay your money and send in the form. It's not just Delaware, it's just that they managed to capture the market by providing company favorable law and a judicial infrastructure that supports that. But it's always been that banks have to jump through many, many more hoops.
Yeah.
It's just that it's always, or at least for a very long time, been thought that there were two choices for hoops. One was you could jump through the hoops to get a federal charter, and the other was you could jump through hoops to get a state charter. But what we've seen since basically the 1930s and the advent of widespread federal deposit insurance is that more and more the federal government sees itself as the safeguarder of the whole system. So although you can still choose a state charter, it's very hard to become a bank if the FDIC says you can't have deposit insurance and the NCUA says you can't have federal share insurance and the Federal Reserve says you can't have a master account, right? So it's become increasingly difficult to have any sort of financial institution that isn't touched by the federal government.
Well, and just to put a final point on this, because I think this has been like an awesome discussion on master accounts and everything related to the controversy that we've been seeing. But to just punctuate that final point, Julie, it's difficult to be a financial institution without having access to some of these, as Kiah sort of referenced, kind of quasi-utilities that a lot of other providers in the market have. I think you referenced at the beginning that when these payment systems were being developed, the idea was to attract people to join as members of the Federal Reserve by offering them at cost. Can you quantify, or do we know what the value of having one of these master accounts is? Because I think it would be helpful for people to understand what people are actually fighting over when we talk about this.
So there are different estimates. Bankwise, which is one of the Wyoming Speedies, has some estimates about how much it would cost. Tennessee, for a while, set up a trust to handle its state payments in order to save money. And they did that for a long period of time until the Federal Reserve changed some of its policies. But they thought that they saved hundreds of thousands of dollars a year by doing it. I think talking about it in terms of money, though, is a little bit misleading because some of it is about money, right? You
Sure.
add a bank in the middle and you got a middleman that you have to pay, or middle person, middle entity, whatever you want to call it. But another part of it is just having regular, reliable access. And so if you are always dependent on someone who sees themselves as your competitor in order to stay in business, that is an untenable situation that is not conducive to long-term growth or disruption of the existing industry. And so when you say that these people or these entities or entities of this type or entities from this state can't get access, what you're saying is that they are going to have a very difficult time competing with the incumbent financial institution. And maybe will never, ever get off the ground simply because they have to start off, behind the start line.
That makes complete sense. Kiah, I know you have more questions. We have to be judicious with Julie's time. But before we let you go, Julie, there were a couple of quick topics we wanted to hit. One that came out this week, as a matter of fact, was the independent review of the allegations of sexual harassment and interpersonal misconduct at the FDIC. This was something that was reported on a while ago, and the FDIC has been going through this independent review in order to try to substantiate some of the allegations that were raised by that reporting. The report was published this week, and I won't summarize the details because, quite frankly, they're gross, but suffice it to say, it's not good. And I know this is new news this week. I have not read the entire thing, just sort of skimmed the kind of key takeaways, but I thought you had a good sort of overarching take that you shared on Twitter that I'd love for you to just kind of expound on here. But what was your sort of initial reaction when you saw this?
Yeah, so I have had a chance to look through the report, and it is, I think, very, very troubling. One of the things it discusses is that there's almost never any follow-up or consequence for people who engage in sexual harassment. And
Yep.
there are also allegations of widespread discrimination on the basis of other protected classes. Beyond that, the report says that there is a culture of an old boys network where people use their personal connections to get ahead. The report says that people don't report wrongdoing when it happens because they fear retaliation. And the report says that some of the concerns go all the way to the chairman, and his treatment of the people that he deals with suggests that in some instances he's, berated people and been really angry. And it's very troubling because, if the FDIC saw that at a bank, I think that they would rightly think that this is a very huge risk.
Yeah.
But what seems to me to be missing from the report is the consequence of that. And, if it's a big risk, if you have it at a bank, it's got to be an even bigger risk when you have it at the main insurer of all banks.
Right.
And I guess the other part is, this is describing a culture that pervades the agency. And
Yeah.
I'm not sure why we think that the bad actors at the FDIC would be dismissive, angry, harassy to their coworkers, but not to the employees of the financial institutions that they examine and oversee. And so the thing that I think is still out there and worrying and hasn't been directly addressed is what this means for the FDIC as a regulator. And what does this mean about how banks have been treated? And that was beyond the scope of this report that Cleary Gottlieb did. They didn't want to deal with any allegations about how the examination process worked. But I don't know how we could read this parade of horribles about the FDIC and not be concerned about how they treat the institutions and the employees at the institutions that they supervise.
Oh, that's interesting. The FDIC ombudsman they do have an ombudsman who publishes, I believe, an annual report. It's not clear to me that all banks know that, if they are supervised by the FDIC, they have access to the ombudsman and can submit reports. But I would imagine that's maybe where some of that feedback is. But it does it's funny because the sexual harassment is often about how power is enacted. And the power is very explicit in the regulatory bank supervisory relationship, right? Like that's something that comes up a lot, that banks don't want to upset their regulator. And so there's kind of an unspoken way that you engage with your regulator. There are courtesies that are provided to a regulator just so that, you kind of don't run afoul of them. And I think that that's often seen as like a good professional working relationship, but it's also because it's under a permission-based structure. One person gets the veto. And so you kind of need to be on good terms with that person. And then when you have you do have sometimes situations where there's a more antagonistic relationship. It's very public and normally involves a court, and it's kind of rare too. So
yeah, the FDIC and frankly, the other banking regulators, the Federal Reserve in particular, have been very dismissive of the idea that banks don't want to complain to the ombudsman or don't want to use the intra-agency appeals process because they fear retaliation. They're just like, oh no, banks wouldn't fear retaliation.
Yeah.
And so I find it, an interesting juxtaposition that then you read that report and they say, but the employees at the FDIC don't want to report anything because even though there's a law that says they can't be retaliated against, they fear retaliation.
Right.
I think that probably the fear of retaliation is not completely unfounded in either instance.
And it is interesting too. I only read the executive summary because it is just like a really big, horrible, like a report full of horrors. But I was thinking about that today because when you said you wanted to talk about it, and I was wondering what this is a culture of how employees should interact with each other. But the FDIC, and thinking about the spring banking crisis of how do we talk about risks and how do we communicate respectfully within an institution? And if lower level FDIC employees don't feel safe communicating that they are uncomfortable at work and one of their employees is doing that, how would communications around, I see risk building in the industry and I think we need to address it at the supervisory level and maybe at the regulatory level, right? So the FDIC is not just like a workplace, right? It's like it has a really public facing job. It does interact with banks, but also like, to even just say like, how does the FDIC talk to the FDIC? And how are those communications received? Do we have a culture of open communication? I would argue that this report shows, no, we don't have a culture of open communication, right? We don't have a culture of like respectful dissent, things like that. Those are not values that we prioritize from our employees. That's not feedback we want to hear.
So the report describes the structure of the FDIC is hierarchical and almost militaristic, and that there's a chain of command, right? So you have the non-commissioned examiners, the commissioned examiners, the examiner in charge, the regional supervisor, and, you take direction from the people above you and you give direction to the people below you, but you don't step out of line. You don't go around the chain of command.
Yeah.
You don't question your supervisor. You do what you're told, and that's the way that it is. And this is, I think, a model of management that was more common and more embraced in earlier generations.
Sure.
I was recently reading about, now we're getting beyond the bank nerd part of it. I was reading about aviation disasters, big planes that had had something go wrong with them. And, the pilot and the first officer and engineer had to try to get the plane on the ground and save people. And so it was talking about, when they'd been successful and when they hadn't. And one of the changes that some of the airlines implemented was, instead of having a hierarchical, we just all do what the pilot, when an emergency happens, the people handled it better when they had a more collaborative structure than when they had one person that was clearly in charge that got to make the decision whether or not they had the best idea, or whether or not they had all of the information. And I thought that was really interesting, because I would have thought that if there was ever a use case for hierarchy, it would be when decisions have to be made very quickly and the pilot is the one that has the most experience, right?
Sure.
So you want the decision to be made quickly. We want it to be made by the person with the most experience. And, at least this particular article that I was reading suggested that was not the case, that in emergencies, flight teams that adopt a collaborative approach, and they have all the black boxes that they can listen to.
I read that same report, actually, not to like totally leave Kiah in the dust on Bank Nerd Corner stuff. I know, yeah, but it is interesting because I think they compared plane crashes in airline industries in different countries, right, to look at cultural differences. And in some cultures, the mode of cooperation between superiors and their subordinates is one where, you are very deferential to the pilot. If you're the co-pilot, you don't question them or, try to be disrespectful in any way. But they found that, accidents that could have been prevented were way higher in those industries, in those countries, just because that mode of communication doesn't work well in that circumstance. And Julie, I think it's actually a very relevant example in this case. Not that, FDIC examiners are necessarily landing in a plane in an emergency, but going back to the spring banking crisis, you kind of are, right? Like when they get called in to do this stuff, it's not that dissimilar from trying to land a plane that's about to crash. So I think it is actually a really, really good analogy.
I think lots of people would appreciate soft landings in banking crisis.
Yes, I totally agree. And just so that we don't end on like a bit of a bummer. Yeah.
Big bummer.
Let's try to bring the energy back up. You may know if you've listened to this podcast before, we always like to end on a rant and something that just sort of drives us crazy. I normally let Kiah pick it because she has a lot of rants that are just sort of rattling around and she just settles on one. But I think we picked one that you might have a take on. So Kiah, I'll turn the floor over to you.
Yeah, I'll pitch it to you, Julie. I assume maybe you won't get as emotive as I get during rants, but I believe we share this opinion, which is, one of in the tiers, you need to get a master account, you need a routing number. And I was stunned to learn that in the year of our Lord, 2024, routing numbers are still provided by not the FDIC, by not your primary bank regulator, but by the American Banking Association. And I think this is crazy bananas. And so I want you to explain to me why this is the system we have today, and why is it okay that a trade group that represents a very specific type of financial institution gets to decide who gets routing numbers?
Yeah, that's a very good question. And it came to a head in Fourth Corner because to fill out that one-page form that existed at the time, they had to get an ABA routing number. And so they wrote to the ABA and said, please give me one. And the ABA is like,
hell no.
So I guess what the ABA is supposed to do is they're supposed to check with the Federal Reserve to see if you're eligible for a Federal Reserve account, which is a different question than whether the Fed might want to give you one.
Sure.
So there's a two-step legal process. One, are you on the list in the statute? And the second, the Fed says is, are you safe enough for us? And so there was like this round and round about whether Fourth Corner was even a depository institution, even though they clearly were. That was their whole plan, right? Was to take deposits and then lend them out.
Yeah. And
so there was this whole stalemate where maybe the ABA didn't want to give a routing number, and that was going to hold up the Fed. But then, Fourth Corner had a hard time deciding and finding out from the ABA and the Fed, like, who was making the decision. Because when they asked, they were like,
pointing fingers the other way. Yeah.
And by the way, you can't sue the ABA for, violations of administrative law because they're not the federal government. They can do whatever they want.
But they issue routing numbers. That's insane.
Yeah. It's interesting because then it's like, I guess a routing number is not a public thing. It's like you're asking permission for a group to give you it's like going to Costco and be like, hey, can I be a Costco member? Like that. But, to something, I don't know, to like pay.
Be like asking Costco for like your address for your house or something. This is insane.
Like asking Ford for your driver's license. No.
Yeah.
There you go. That's the analogy. Yes.
Why is the ABA involved at all? And if of all the things we should reform, this is the easiest. If the Fed gets to give you the number or the master account, the Fed gives you the number. I don't know why it's like a two-step process involving a third-party trade group that represents banks specifically.
So there are, institutions that don't have a master account that still need a routing number because they use correspondence. But
sure,
we can.
The ABA finds it in their heart to give them a routing number.
Yeah. I hear what you're saying, that it's a trade group that doesn't even represent all of the people who have a routing number. And it's banking. As all bank nerds know, banking is largely the product of historical anomalies, right? The reason that we have so many federal banking regulators is because it's way easier to create a new one than it is to kill off an old one. And so, we wouldn't create this if we were creating something from scratch, but because history, we now have this. It's the same thing with the routing numbers because the ABA took the initiative to do it in the first instance. They still do it. Whether it makes any sense or not, we can argue about that. But if we talk about everything in banking that exists because of history, we will be here till we're all dead.
Yeah, I was going to say, that's like the last podcast we'll do, Julie. We'll have you back for like the final episode and we'll just record for 100 hours straight, sort of trying to get to the bottom of that question. I want to thank you so much for coming on. This was truly a pleasure. I really enjoyed it, learned a lot. Kiah, I know you can check this off your bucket list.
Absolutely. I'm so glad you were able to join us.
Me too. My students will be so happy that I have bored you instead of them. I think they think, wow, she's kind of a banking nerd. That's a little weird. So I'm happy to found.
There's three of us, actually.
Some fellows, yes.
Yes, we all celebrate being bank nerds, and I'm sure our audience agrees with that as well. So, Julie, thank you so much. We'll definitely have you back on in the future. And Kiah, as always, great to see you.
Yeah, great to see you.
Thank you.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.